Hey, good morning, everyone. Welcome back, options traders. Well, this question comes to us from one of the traders right here in our group. And he was wondering, is it a good idea to sell LEAPS options for income? Very good question. We get this one a lot. And like most things with options, it depends. It depends on the reason for doing it. Now, because he worded it for income, I would be very cautious that it's an income generating strategy and that it's more for a hedge. So let's find out why. Before we get started, please be sure to click like. It goes a long way in promoting the channel and is always very much appreciated. So to answer this question, we have to go back to our square root pricing rule. And recall what that is. It's a mathematical property that applies to all of our options, and it says that it takes about 4 times the amount of time to double an option's price. Now this applies to the at-the-money options only. And the reason for this kind of an odd pricing relationship is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So that's where this comes in. So what exactly does this mean? Well, let's say that we have a 1-month option trading for $1. What would a 4-month option be worth? Most people would say, well, it's obviously it would be worth $4. You've got 4 times the amount of time. And it turns out that's not true. The way that you figure it out is you find out how much time we've increased from the first to the second option. So that's a factor of 4. The 4-month option has 4 times the amount of time as a 1-month option. So now that we know that that scaling factor is 4, we take the square root of that, we get 2, and that tells us that we have to multiply this option's price by 2. So the 4-month option we would expect to be trading for $2, not $4 like a lot of people would expect. So if we had made this first option instead $3, then we multiply that by 2, the 4-month option should be trading for about 6. So let's try another one to be sure that you understand. If we had a 3-month option trading for $5, what's a 27-month option worth? Well, again, we find out the scaling factor over here. That's an increase of 9 times the amount of time. We take the square root of 9. That gives us 3. I know that over here I have to multiply this first option's price by 3. And so that tells me that the 27-month option should be trading for about 15. So regardless of how you cut it, what it shows is that longer dated options become a progressively better and better deal for option buyers. Yes, they cost you more in total, but they're getting cheaper per unit of time. And so it's becoming a better and better deal. It's like buying things in bulk. And therefore, conversely, longer dated options are becoming a worse and worse deal for the option sellers because you're selling cheap units of time. And this is where traders get trapped because they say, wait a minute, I'm getting $15 instead of $5. Well, that's sort of true, but you're getting $15 for 27 months as opposed to $5 for just 3 months. So once we start talking about LEAPS, this is where it really makes drastic differences. LEAPS are, as most of you know, long-term equity anticipation securities. That's where the acronym comes from. And they're nothing but long-term options. A standard option is 9 months or less. So these are options that have expirations greater than 9 months and as long as 3 years. So the question that this trader is asking, should you sell these LEAPS for income? Well, again, we have to go back to this square root pricing rule. And when you really think about it, it just doesn't make a lot of sense. So for instance, here's a 30-day option. And according to a pricing model, let's say it's trading for $3.43. Well, if we wait all the way down till expiration, that option is worth 0. And therefore, you've collected the entire $3.43 over 30 days. So 30 days later, that option has lost $3.43, which of course, because you are the seller, becomes a gain to you. But watch what happens if you had gone out to, let's say, a 720-day option. Now, using those same factors in the pricing model, it says that this option would be $16.69. So yes, you would receive more money up front. But look what happens. 120 days later, it's only dropped to $15.25. That's $1.44. So in the first case, you got $3.43 for 30 days. Now you're having to wait 120 days just to get $1.44, less than half. See, this is why you really have to question about selling LEAPS or any type of a longer dated option if you are strictly talking about time decay and collecting premium. Again, traders get trapped into seeing the amount that they're receiving from the sale of that LEAPS option because it's more money that they think it's therefore going to decay faster. It just isn't. It's actually going to be better for you, in this case, to sell the 30-day option 24 times, because there you would get the $3.43 24 times. That's a whole lot more than $16.69. But where might it make sense to sell a longer dated option? It makes very little sense to sell LEAPS for income. Again, if you are emphasizing the word income, and that's because you would be better off selling shorter dated options over and over. However, because longer dated options do cost more, the main reason for selling LEAPS is for the downside hedge. So here's a case where you could make an argument for it. If you said, I'm trying to get X amount of dollars over a 6-month period or over a 1-year period, and that's going to meet my goals, and I can do that right now on day one with a 1-year option by selling this LEAPS option, sure, you could make a very good argument for saying we've got the bird in the hand, we've got all of this cash up front, we've got a much bigger downside hedge. See, if you sell the shorter dated option, especially if it's only a week long or a couple of weeks, you might only pull in 75 cents. And even though it's a lot more per unit of time, it's only a 75-cent downside hedge over the next 30 days. And if that stock really becomes unraveled, it's not going to do a lot of good. Whereas by selling the LEAPS, it would. So that would be the main distinction. Now, there are a lot of other reasons why you might sell LEAPS. It could get into interest rate plays, lots of different reasons where LEAPS can be beneficial. But just because this trader worded the question about selling LEAPS for income, I think this is really where he was headed. And I think, at least for starters, if you're considering selling LEAPS for income, you should really reconsider it. You should be selling shorter dated options for income, but selling longer dated options for the downside hedge. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Options A to Z Facebook trading group, and you can find a link in the description below.